Trade limitless on HMX, the next-gen decentralized perpetual exchange. Trade crypto, FX, commodities with up to 1000x leverage on the Arbitrum network. Benefit from low fees, multi-asset collateral support, and cross-margin flexibility. Check them out.
From meme to utility, Floki has it all. NFT metaverse game called Valhalla. Floki University, DeFi, charity, and shopping. Floki is governed by the people, for the people. Floki, together there is no stopping us.
Hello there, it is Adrian Zdunchuk, CMT, Charter Market Recognition, Crypto Burp, as some people call me. And, well, this is the second day of our 7-day Free Trading Congress, the 5th edition of our Free Trading Congress 7-day virtual trade camp, where people come and pick up the most reliable, credible information from the trading side and perspective, from technical analysis, from the whole world of financials, right? The financial information. There's so much uncredited, there's so much false information, there's so much noise, there's so much fugazi up there. There's this, fake gurus, self-proclaimed experts that they never get anything right in their life, and that's a problem, because those people typically have a lot of voice, while the people who actually deserve the greatest recognition, the people who are the best professionals, the people who actually commit to this industry for years and decades, well, they are the ones to be put on the pedestal. And I'm so happy to be joined today by my dear friend and an excellent legend. And anytime I speak with Jeff Hirsch, because that's the very expert for today's session.
We freeze? Hello.
Hello, everyone. So we're having technical problems with Burv right now. I think he freezed. All right. So how are you doing, Jeff? Burv was introducing you. We can continue. We can continue the session until Burv is back.
You want me to go through some of the stuff I prepared?
Yeah, for sure. We can go through it.
Okay.
All right. So let's ready to roll. All right. So let's start here. Let's do it.
Well, my friend Adrian seems to have some technical difficulties. This is the nature of the modern world. So appreciate you guys having me and joining me today. Wait, there he is.
Yeah, someone kicked me off, man. Sorry about that. Like I said yesterday, there was a fire alarm. So, get yourselves and hold on tight, because there are going to be some technical stuff, that's for sure. Because we are talking about technical analysis, so there has to be some technical stuff on the side. Again, Jeff Hirsch, my good dear friend, CEO of Hirsch Holdings, the publisher, the world's famous publisher of Almanac Trader, that I read it myself, full disclosure. I'm addicted to what Jeff does in terms of all the professional knowledge that he shares. Editor of Stock Traders Almanac, including the 2024 edition, was just kind of like freshly come out. And he always goes by the quote, those who understand market history are bound to profit from it. And that's actually true. And ladies and gentlemen, give it a round of applause, and please welcome warmly Jeff Hirsch, the one and only Jeff Hirsch. How's it going, Jeff?
It's going great, man. My Bitcoin trade is up substantially.
That's a good thing.
Friend. I'm not a huge token guy or anything, but I'm an ETF and stock guy. So GBTC was a great idea. It was a great trade, and correlates really well with the price of Bitcoin. And it was a little bit discounted when we published our piece and got in. So it's firing on all seasonal pistons right now, man.
That makes sense. So, well, the good thing is that, we have about 55 minutes, 50 minutes for an excellent session. So everybody, please hold on tight to your chairs, because this is going to rip. This is going to be literally face melting session for everybody, because what Jeff does and what Jeff is famous for is the not only seasonality of the things, not only the seasonal patterns, they go so well beyond that, right? We were talking about the market timing with the actual technical strategies, the fundamental research, the macro research. There's so much that Jeff is about to unveil and release for you, everybody. So please hit a subscribe button, smash the notification, likes as well. But you know the drill, you know the drill, you know the drill, you know the stuff. And well, Jeff, what have you got for us for today?
Well, I mean, I put together a little deck with some of the stuff we're looking at. I mean, just, there's a couple of agenda points that you had put for our session, our class here, and I keyed on those about leveraging seasonality and trading strategies and the predictive power of seasonality and realistic expectations. So, I mean, I'll put up the history. My father started this business back in 1966, the year I was born. I know there's a lot of young ones, out there on this call, including my partner here. We joke that I'm a boomer, sort of. I try not to boom around on the tech right now, but anyway, the new almanac, the 2024 edition, the 57th, same age as me, is out. We are actively putting together the Commodity Traders Almanac for 2024. And at some point, maybe we can do something with crypto and Bitcoin. But here's some of the other books that we put out there. The first edition of the Stock Traders Almanac is the 1968, came out in 67. Some seasonal trading books. My father's Don't Sell Stocks on Monday and the Super Boom Forecast. I don't know if everyone remembers, but back in 2010, when the Dow was at about 10,000, May of 2010, using one of Yale's famous patterns, I don't have it in the deck today, but I'll just explain a little bit about 500% market moves following war and inflation and technology, what I call culturally enabling paradigm shifting technology. And, some of this stuff that we worked on, Bitcoin and crypto and all that stuff, blockchain might be part of it, creates these booms. And he did it. He made a forecast for 34.20 back in the 70s. I made forecast for 38.820. That's a whole other presentation, but here we are looking at what, Dow 35,000 today. Is that what we're looking at roughly? I'll take a quick look. Yeah, about that. Right on. So
Close on. Yeah, 34, 90, 91.
the projection was for 38.820 to be reached in 2025. So we are on schedule, ahead of schedule, and then some of the other stuff, other places we get to appear. But the disciplines, we get sort of pigeonholed a little bit into seasonality, which I love. We had a great experience working together, collaborating on the seasonality of Bitcoin, the paper we put out back in September. But I look at fundamentals, and I know you're a technician. I'm going to follow you. I have one level of the CMT myself. But I also look at fundamentals. One of the first things my father Yale taught me when I started about 1989, 90 was price to sales ratio when looking at stocks. So we use fundamentals, technicals. Of course, we look at monetary policy and macro trends and government situations and whatever's going on in the world, as well as market sentiment, market internals, advanced declines, new highs, new lows, all that kind of stuff. To create our portfolio. So it's basically taking the almanac and putting it to work with the seasonal patterns and the rest of the inputs that we get from the market and the economy. So here's my quote that you used. It's a sort of a flip on the old Santayana quote that those who fail to remember the past are condemned to repeat it. As you so brilliantly quoted me, those who understand market history are bound to profit from it. That's what I think. That's my philosophy. And I threw in our favorite chart. You put together some wonderful charts for the study that we did, the groundbreaking study, if you will. And this is my updated version of the seasonal pattern for Bitcoin. I want people to just realize there's two scales here because of the Wild West early days of Bitcoin where they were rallying. This is percentage change. So we got the all years and 2011 to 2017, the first full year through when the futures started trading on the CME. On the left scale, right scale is 2018 to 22 in the green line, and the orange line is the current year. This is updated through yesterday's close, and I've been using the stock charts data. It looks like they use Greenwich Mean Time as the close there, which is fine. Like they use midnight there, I think, as the end of the day. So that's the one I've been gravitating towards. I know we've had some discussions about ironing out the data because of the 24/7, 365 trading pattern. Like, when's the close? How do you do a technical chart on something that's constantly moving? You got to have a closing price or something. Anyway, seasonal pattern, amazed me how close it tracks stocks. Even though there was a little bit of flight to safety during some of the recent geopolitical turmoil, but still, here we are in the best 6 months of the year for stocks. Crypto, Bitcoin have been just blown out of the water. What did you call spectacular pumps? I think is your word. Like, who doesn't love them? Face ripping rallies is one of the other phrases that they use here. But you can see that this seasonal low, and this is why Adrian and I published this study right here at the end of September 26th to be exact. I think it lined up on your analysis, your charts as well, that was sort of the annual seasonal low period. And lo and behold, bam, it just bottomed pretty much right there. It was a little bit lower earlier in the month. Okay, fine. But I got into GBTC a little bit after that. I was up over 40% with that trade yesterday. And this is just quintessential seasonal trading. I mean, it's not going to always be this easy, everybody. Same thing with the stock market. And one of the things that I was telling Adrian about, or sort of sharing with him my feelings when we were going over this stuff, was that it's sort of a proving time for Bitcoin, for crypto, that if it doesn't rally like it should during the seasonal period, maybe there's something wrong going on there. And then we also looked at the halving cycle, which I didn't put that chart in there. I thought you might share that, but again, it's gonna have to show the pattern that Adrian highlighted with never going back to the halving level afterwards, and it's sort of like almost like a little cup and handle into for those your technicians out there into the halving. So we'll have to see. So that's the crypto take, the Bitcoin seasonal trade. I wanted to show everyone a little bit more of what we do and how we use the almanac and put it to work. We have a newsletter subscription service, and everyone gets a free copy of the book. I don't know if anyone's seen it. Here's my 2024. Did you get yours yet?
Man, I haven't. I know you sent it. I haven't just yet, man.
Shipping. Who knows what it takes for the post to get to Poland or whatever? Or I think that's where you had me send it. But if not, we'll have to rendezvous somewhere, and I'll give you one. But
oh yeah, I'll pick it up, man. I'll pick it up. I've been on the planes, past several times. You also mentioned You also mentioned face ripping, right? You mentioned ground rank, and you made like, don't forget face melting, man. That's what crypto folks love.
Face melting. That's
if it melts your face, right? This is the melt facing rally, melt facing pump, man. Don't forget. Don't forget that.
So this November run, I mean, is just really on cue. I just got to watch out for this. Another thing I'm just seeing right here. I don't know if you guys can see my pointer. I don't know if I have one on here, but if you look into mid-December, this is a very typical stock pattern, seasonal pattern. The first half of December can be a little bit weak with tax loss selling and people gearing up for year end. So you can see that in some of these seasonal patterns for Bitcoin too. So I know you warn people not to trade it too much, not to get whipsawed out, and you talk about the 200-day moving average as being sort of a buying level. Just be careful and be aware that there tends to be a little bit of a selling in early December, along with the stock market ahead of the year end, Santa Claus rally, which I'll explain a little bit later. So let me just move ahead here, if I can. Small stocks, moving away from crypto and Bitcoin for a second. There's something called the January effect, which is the tendency for small caps to outperform large caps in the month of January, as we show on pages 112 and 114 of the Stock Traders Almanac, the 2024 edition. Most of that so-called January effect takes place in mid-December, the last 2 weeks of December. You can see that right here on the chart. This is the seasonal pattern, and we start this in July and go to June, so we can highlight the year-end rally, just sort of a little statistical or graphical representation. And here we have everyone's talking about how horrible small caps were. Yes, rate hikes and the economic environment wasn't so conducive to small cap, but it's also was trading right along with the seasonal comparison of the 2,000 versus the 1,000 large caps. And this is from last Friday. We all know that the Russell had a huge day the other day. Full disclosure, I own the IWMs as well, and the DIA and the SPY and the QQQ. I trade my own cooking. And so this is set up really nicely for small caps. I'm going to show a few stock picks a little later, but I'm just putting the large caps up there because the small caps, it's not something we can just blow out in the world. And that's for paying subscribers as well. But we have a few small caps, a bunch of them in our new seasonal basket of stock picks, brand new. And I'll tell you about how we select those in a bit. But again, open season on small caps, right ahead of the usual small cap effect, which starts in mid-December. Now, just going to go back a little bit to October. Everyone was all concerned about October and the bear market and the seasonal sell-off. We'll see some more of the very typical selling from mid-July through October, but we've been talking about October being, and October phobia being a bear killer, a bargain month, and a turnaround month. This is a shot of the 1969 Stock Traders Almanac, where my father highlighted this tendency, this seasonality, way back when. There's a few things that happen, in October, but just on a calendar basis, and just illustrating and highlighting the habitual behavior of human beings and traders en masse with their money seasonally. I mean, the year ends in December. We all celebrate the New Year's. Yeah, there's some Jewish New Year's and Chinese New Year's at different times. But basically, the quarterly schedule of institutions, mutual funds, hedge funds, private equity, all that stuff, they revolve around the quarterly basis. And then, there's lots of selling in September, the end of the third quarter, the portfolio window dressing, restructuring. And then they get in October. There's this October 31st deadline for the IRS. It's in the tax code in the U.S. that these funds, these 40 Act funds, have to file and reconcile their accounting with the previous year's 10 months, the previous year's full 12 months, and the current year's 10 months. And they have to do that by October 31st ahead of the year end. And then there's this whole, that people want to be, getting their portfolios looking nice for year end statements. And then there's all the forecasting and projecting that goes on, and all the year-end bonus money and seasonal money and investing that goes on, the retail sales, all the shopping that sort of drives this thing. And here you have October sitting at the, the enviable, as he says here, it's enviable position in the calendar, falls in front of the most bullish 3-month span of the year, November through January, the 3 best consecutive months of the year. So anyway, just a little shout out to my late father who discovered this. Oh, geez. How many years ago was that? Somebody do the math for me. 54?
Yeah. For everybody, you heard that right. That was 1969. That's
I was
the correct date. There's no typo. And Jeff was free. I was minus 30 something.
A lot.
I don't know how that works. Go ahead,
right,
please.
Let me just jump forward here. All right. Everyone talks about sell in May. Go away. Forget it. We reposition in May, but my phrase is buy in October and get your portfolio sober. Have a little fun with that. This is just the seasonal pattern of the Dow Jones Industrials. I don't know if you saw my new hat, right? I got to update my screen logo, but there's the see this line here?
That's a nice hat. That's it. Hold on, that's a Stock Traders Almanac. I see that line. Hold on, what is that going to be? That's a chart. That's a chart. What's that?
Does it look like anything else on the screen?
Oh man, there you go.
It's the black line. It's just the 50-year seasonal pattern for the Dow Jones Industrials. So this is
smart.
A lot of people go back, skeptics, and they try to disprove the best 6 months, which is what Yale created in '86, the best and worst 6-month switching strategy, which there'll be more on that in a second. And they go back to 1896 when the Dow started or whatever, which is kind of silly because it was a different world back then. Most of the economy was based upon farming and the agrarian economy. And the good solid data I was able to back test or back check goes to 1901. And you can see in the red line, 1901 to 1949, it was almost buy in May, when you had, the beginning of the planting and sowing and buying a seed, fuel, fertilizer, hiring, taking out loans. And then, when harvest happens and the loans come due, you see this sort of selling, ahead of harvest time. And it was sort of a buy in May back then. But since, World War II, since the industrial military complex and the service economy, you have this, sort of Memorial Day to Labor Day. The whole phrase "sell in May and go away" comes from an old British saw. It goes, "Sell in May and go away, and come on back on St. Leger's Day." St. Leger's Day is the day of the St. Leger Stakes thoroughbred horse race. It's the final leg of the British Triple Crown, and it happens in mid-September. Now, I don't know if anyone's watched Downton Abbey or any of those shows, and you have the London season, right, which goes from sort of September through May. And London was built on a swamp pretty much back in the old days. So it got pretty nasty in the summer, and they would all move up to the country, the aristocracy, the merchants, the bankers, and they would, have their parties and their horse races and stuff. And then after the St. Leger Stakes race, they would come back to the city of London and start doing business again. Now for us, it's sort of Memorial Day to Labor Day, where people go on vacation. I'll play a lot of golf, notice the golf hat, and go to the beach, the mountains, the kids go to camp, people take vacations. Europe used to take off all of July and August, right? I mean, it used to be this. It's a little different now. You guys,
Let's bring it back. Let's bring it back.
Yeah, I'm with you. And the 3-day work week. No, just kidding.
That's it.
But anyway, and then the green line is since 1988, since the 87 crash, when the New York Stock Exchange put in the circuit breakers and triggers and all that stuff, collars and all that, and what have you. So I want to keep moving. I got a few other slides to get to. So here's the page out of the back of the almanac that sort of shows the worst 6 months, May through October. Yeah, the first month of quarter, July, we've seen that pick up. There's some NASDAQ tech stock influence there. And then October has become a turnaround month, but still August, September weakness. And this is the chart that sort of gave Yale his aha moment, his epiphany to create this, the best 6 months of the year: November, December, January, March, and April. February is the weak link. People tend to readjust forecasts and outlooks. So that's basically just, the bar chart. This is something that we did with crypto too, that everyone looks at these days. But Yale started this back in the old almanacs in the 60s and 70s. Technical analysts, pay attention. David Aronson, who's on the markets list that I think you got added to, right? David puts a lot of great information out there. Back in 2008, he did a book with Timothy Masters at Baruch College in New York City, which is affiliated with the CMT. And they took 6,200 different black box systems and put them through the scientific method, disproving the null hypothesis. Found that none of them had predictive power, and they were all the result of chance. And when we picked his book as the best investment book of the year, we asked him to run the best and worst 6 month switching strategy through the same paces. And he did that starting in 87 because it was published with data through 86 in the 87 Almanac, which came out in the fall of 86. So unlike all the other things, I mean, you know what the ending is here. Unlike all the other 6,200 different black box systems, this was the only one that did have predictive power and was not the result of chance. So it works. Yeah, it's not perfect. Nothing works 100% of the time. Adrian doesn't work 100% of the time. I don't work 100% of the time. Crypto does, though. It's always open. Bitcoin. Anyway,
that's such a good line. That's such a good line.
So Dow, just using the old, granddaddy index of them all, 7.3% November to April on average since 1950, 0.8% May to October. a little hypothetical $10,000 in 1950 in the beginning, gains over $1 million in the best months, gains $3,400 in the worst months. I assume this group knows what MACD is, right, Adrian? Moving average, convergence, divergence. We use a MACD trigger, 2 different ones. I'll show you that in the chart in a second, but improves entries and exits, sometimes a little bit earlier, sometimes a little bit later. We start looking on October 1st for the best 6 months to get in, April 1st to get out. And it turns that average gain to 8.9%, the little 0.8 gain to a loss of -5, and it nearly triples the gains to over $3 million in that, 10,000 invested in 1950, and that little gain of 3,400 turns into a loss of about 5,400. So it works. I use it, and this is, what it is. So I just want to keep moving here because I want to give us some time to get into some other things, but this is the most important market seasonality period of the year. There is a host of, different strategies coming up. We just have a new page in the almanac, the Thanksgiving to Santa Claus rally trade for the Russell 2000 small caps. The Tuesday before Thanksgiving to the second trading day of the year, which is the end of the Santa Claus rally. You have the January effect, the small cap effect I talked about. You have my January indicator trifecta coming up, the 7-day Santa Claus rally, the first 5 days of the year, the January barometer. That's really not a tradable or a trading strategy. Those are indicators, and that's part of my thinking of what happens if our assumptions are wrong and are wrong, and what could change my bullish outlook for the year end and 24. But right here is the S&P 500, my different seasonal cycles. This red line is my aggregate cycle. This is a combination of all years, all pre-election years, the third year of the U.S. presidential election cycle, and third years of the decade. So that'll change for next year. It'll be election years and fourth years, et cetera, so forth. And then, all pre-election years in this black line. The green line is pre-election years after a midterm bear market. I don't know if anyone knows, but I was one of the few. There were some other solid, colleagues that I know that called the bear market bottom in October of 2002. It was a textbook midterm bear market. We were out early, or we let our stops get triggered in different stocks and ETFs, and we were expecting that. So, and then we got a president, though he's been around for a long time. It's his first term. No matter how you slice it, that's the blue line. So where's the S&P up as of yesterday? About 17.5% or something for the year. So we're right on schedule for a little over 20% in those scenarios, which was my forecast for the year back in December of 22 was about 15 to 20% for the Dow and S&P and NAS a little bit more. But, early in the year when we hit that January indicator trifecta, which I'll show you in a second, my biggest concern was I wasn't bullish enough. And then we had the banking thing in March, then, maybe I was, back, whatever. You set your analysis when you're unemotional and not watching the market, and it was pretty sound. So let's look at the NASDAQ version of this. Meanwhile, before I forget, I assume it's obvious 2023 tracking this pattern, very closely. This little October low is just right out of the book, right out of my book. And here we are back on track within a matter of weeks to the pre-election year, first term and after midterm bear pattern. So pretty solid there. NASDAQ, best 3 months, November, December, January. This black line here is all years, not just pre-election years, just to give a little, different look. The same aggregate cycle for NASDAQ, just pre-election years straight up plain because they're big enough, up at what, 30-ish% as it is. And then, the purple line is this year. And I left my little note, which I put in much earlier in the year, which I know Adrian's tracked this pattern a little bit. I think you used this chart a couple times yourself. And this mid-July peak, which has become sort of a really pronounced seasonal pattern. And there's a little trade right here. I don't know if you can see it on the chart. End of July, end of June to mid-July. Last 3 days of June, first 9 trading days of July. We call it Christmas in July. Mid-year rally, whatever it is, right on schedule. And here it is. You see this year peaking. You know, I had to change the scale on this a couple of times to fit it all on there, but we had that mid-August low, a little bit later than some of the averages. You know, rally at the end of August. You can see it tracking. September selling, October selling. I mean, let's just be leery that this seasonal pattern and the 4-year cycle has been firing really on all pistons and tracking very closely since 21. Let's enjoy it while we can. There'll be other years when it's not going to be this easy.
Yeah, if you have to adjust the scales for your charts, that's a good thing. That's a good problem to have, right?
It tells you something's going on, right?
It tells you something.
So just a little idea of what we do. I mean, we use MACD to get more aggressive and defensive. We email out our signals to members on or after October 1st. The sell signals April for Dow and S&P. NASDAQ has a best 8 months, so we don't look to sell that until June, which worked out great this year. You'll see that. And in our annual fall buying spree, which we did, we rolled out new trades for ETFs, all the sectors, ETFs. And we have a new stock basket out there, some undervalued brand new picks, fundamentally screened. But, you know, May to July, we just reposition. We don't sell. You know, we sell some things. We sell our losers. We let our winners ride, but we don't go away. So that's kind of the general strategy. Here's the technical chart. The 2 MACDs. I have it spread out a little bit to show you the last couple of years. Here's the April sell, April 22, as the bear market was kicking in. We were stopped out of most of our ETF and stock trades by this time, and avoided a lot of this. And this lined up, this August peak lined up with the aggregate cycle for midterm years and second years of decades. And that's sort of the summer rally hype that we were warned not to get sucked into. And again, we had in October, our signal got a little early. We had a big pop in early October, but either way, we capitalized on most of these gains. The NASDAQ trade was even better. We got out again in April 23. Yeah, we missed some upside there, but from the June sale for NASDAQ, it's okay. So we just sort of reposition during this period, which is fine while it's going up. Nice buy signal. Looked like, oh, we were too early, but now we're right on time. And for the buy, we use the 817.9 because it's a shorter, faster MACD, because as you can see here, bottoms are more of an event, you know, a V thing, and tops are kind of a process. So we use the slower, longer MACD, the 1226.9. And this is the daily, right out of the original work from Jerry Appel, who created MACD. And then I'll just show you some of the NASDAQ signals. So I didn't go back to April on this one because whatever, it's just, you can't do everything. You can see this June sell was pretty solid. We went nowhere until the buy. Yeah, it went against us for a little bit. Okay. I bought a little bit more. So it was my father's, would have been my father's 100th birthday, October 23rd. I put out a little post on a little, you know, something to honor him on X, Twitter, whatever, and other places. And as I was getting towards the close on that Monday, remember his book, you know, if you remember, Don't Sell Stocks on Monday. So I had,
that was a beautiful post. That was a beautiful post, by the way.
Yeah, it was you know, made me a little verklempt, if you will. But I bought stocks in his honor. I bought more diamonds, spiders, cubes, and IWMs that day. Again, not the exact bottom, but it was the Monday before the Friday low on the 27th. So I don't know. It was just sort of a way to honor him, but also the market was selling off on Monday, and I jumped in there at the close, or just before the close, and added to my position. So that was a good trade. Sector seasonality calendar. This is right out of the Stock Traders Almanac. You can see we have B, E, and M, beginning, end, and middle. We break the month up into thirds. We have some shorts here with the negative signs on there. We avoided the oil and gas short in September. where's that? Yeah, here it is. Natural gas. There was one in, yeah, but we did well with transports, industrials, and the semiconductor shorts were great, and we covered them and right around our buy signal and went long. Here's this just big cluster of sectors going long. They're all doing well right now. And then oil's been having some issue. There's a nice trade in December when oil tends to make the seasonal low, and we'll be looking at that. We'll put out and we don't just tell people what to buy. We say when, what price, where to put your buy limit, where to put a stop loss. And for these sector trades, we put in an auto sell. It's not a target, but it's about 10 percentage points above the averages you see on this page. And then if we hit that, we take it off the table. So here's the look. This is from the beginning of the month. No, I didn't update this one. I thought I updated. Anyway, this is our old bond positions, but you can just see the sectors. These are all back in the black now. Went a little bit against us, and you can go to stocktradersalmanac.com if you want to see the updated versions of that. I think we'll be putting out the updates in the next couple of weeks, and then we'll have our December outlook and the December almanac coming up. Let's just talk about the stock screening process for a second, because this is where there's some real juice. I don't know. Is there a better word for in the non-boomer vernacular to talk about where the spectacular pumps might be?
I don't know, Rob. You may want to use Riz, just like you taught me the other day. Riz, just say whatever Riz, and it's gonna fit in nicely.
Yes, I forgot about that. This is where the Riz is in the stocks. So we use our seasonal overlay. We come into October, we look for that turnaround and getting it into the best months of the year. And we've also found that we've done better waiting for earnings season to be over and picking these stocks in early November once all the quarterly stuff has been filed. So, October, November, we go long. In the summer, sometimes we go short, and we do the opposite screen of the long side. But shorts are hard, and I'm not a professional shorter. So normally we just look for some, defensive positions in sectors that do well in the worst months and that may pay a little dividend. This isn't the crypto trading. This is something to do with all that money you make in your crypto trading. You want to, diversify and put it into something conservative while you trade in your cowboy account. This is what this is all about. So we do a pretty robust fundamental screen. We're looking for stuff that's off Wall Street's radar, not the Magnificent Seven or the FANGs or anything everyone's talking about on TV. We want an edge. We want to get stuff before other people get it, and that people aren't really talking about. So we look for the acceleration of growth in revenues and earnings, quarterly, sequentially and year over year, and we look for good valuations relative to the market. PEs, price to sales ratios, good margins, cash flows, debts. And then we look at ratings. And we don't care what the ratings are. We want to see how many people, how many analysts are rating the stock, are following it. So all things being equal, we have one stock that's followed by 20 or so analysts or whatever, another similar numbers followed by 3 or 4 or 5. We're going to go with the one that's followed by fewer people, because people haven't realized what we've seen. Now, one of the highlights from last year was super microcomputer, which became big in the news. We bought it, or we put it in our portfolio at $81.93. It went up over 300. It became the biggest stock in the Russell 2000. I just heard him talking about it on CNBC yesterday. And the other one, which I'll show you in a bit, was Excelis, which we held on to in the same sort of AI, chip computer-driven rallying category. That made it through our screens again, which you'll see. So then we wean down these, whittle down these tables. We do it by hand, and then we get into some technical analysis, looking for chart patterns, relative strength, support and resistance, moving averages, and just some old school fundamental technical research. And we let the screen tell us what's happening in the market, and you'll see a few of the stocks, the larger cap ones, This is the existing portfolio as of the last update. See, it's very lean. You got Excelis and Supermicro in here in the mid caps. Oh, we broke it down. The three caps are under $1 billion is small cap for us. 1 to 5 is mid, and over 5 is large. I know that's still kind of small in the big picture, in the big world, but that's our areas. You can see we have buy limit, stop losses, current advice, net return, and also we always sell half on a double, which might be something that people can use for their Bitcoin trade or the crypto trades, especially right now with the big pop we had. You sell when it doubles, you take your initial investment off the table, let your winnings ride, et cetera, so forth. And here's just the large caps from my list. The ones that are over, I think 2 billion, or I think I picked the ones over 4 billion just to keep it in market cap. So you got Excelis, equipment maker, consumer stock, aerospace, computer tech, finance, construction. Now, admittedly, we don't necessarily know or care about the story or what they do. We'll figure that out later. We want to see that these companies are making money and growing accelerated manner and are underfollowed, have great valuations and a good looking chart. And the relative strength, we want not to be beating the market, not to be lagging the market, but just sort of humming along quietly, doing a good business, making some money, and just be kind of a sleeper pick. All right, Santa Claus Rally and a January barometer, invented by Yale Hirsch back in 1972 in the 73 Almanac. You can see them right here and right here. The Santa Claus Rally is not any year-end rally. I know people use it that way. They're going to continue to call any fourth quarter, Halloween to the year-end, but the Santa Claus Rally is the last 5 trading days of the year and the first 2 trading days of the new year. And the phrase that Yale came up with is, if Santa Claus should fail to call, bears may come to Broad & Wall. Broad & Wall is where the intersection of the New York Stock Exchange, for those of you who don't know. Basically, you know,
pure talent. I love the
these
line.
days. What's that?
I love the line.
Oh,
There was a pure rhyming talent.
He was a songwriter, you know. He was a
songwriter.
Yeah.
Wow.
I think
I'm learning.
music. He had a degree in music, Adrian, from Brooklyn College.
I didn't know that.
On the GI Bill.
What did he study?
What's that?
What did he study?
Music.
Yeah, but any specific, like an instrument class, or what was that?
No, like theory, like
theory.
He played piano. I mean, I'm sure he dabbled in a few other things, but it was, a degree in music. It wasn't, like a violinist. It was music, like songwriting. Gotcha. But I think part of his ability to recognize patterns and his knack and iconic thinking with the almanac and the market came from his understanding and embracing of music theory and writing songs, and the whole structure and math of music seems to have made him, really talented at looking at stock patterns and history and behavior.
Excellent talent right there.
Yeah, and writing lyrics and writing songs. You got to listen to what goes on in the world. You got to pay attention. All right, so the trifecta, the indicator trifecta, we stood on Yale's shoulders so we could see further. About 10 years ago, my partner Christopher and I, we were looking at some misses by the January barometer, which, as January goes, so goes the year. There's some changes in seasonality you've experienced. There's been some selling in January. There's been some rough Januaries. We had, some pretty bad ones. But we found that taking, a combination of the Santa Claus Rally, the first 5 days of the January barometer, when all 3 are up, the S&P was up 90% of the time, 17.5% on average. And we have the last 11 months here, just so we don't include January's gains in the averages. So after January, it's still up. What is that, about 80% of the time? 27 out of 31 years for an average gain of 12.3%. What was the S&P up today? 17.5%. We're already there. Whenever any of them are down, the year's results are reduced. And this is when we sort of up our forecast in February of this year to the best case scenario, excuse me. And as I said, maybe I wasn't bullish enough. But this is also
16.95% year to date, S&P.
Right. It's down a little bit today.
It's floating around the surface. Yeah.
So I think I have the quote later from Edson Gould that I'll show you that he passed away in '87. He did a publication called Findings and Forecasts, and his line it'll be quoted later, but I'll see if I remember it. If the market doesn't rally during the bullish season or the bullish period, there are other forces that are at play, and when that season is over, those forces may really have their say. So while I'm very positive on the market for many reasons, seasonally, 4-year cycle-wise, resilient economics, tame inflation numbers, some of the technicals, things on the world stage are rough. The amount of deficits in the world are rough, but it looks like the Fed, after being wrong on transitory and late on hiking, they may have caught up and maybe engineering a bit of a soft landing. I think similar things may be happening overseas as well. Not quite as nicely, as perfectly, or as potentially as it is in the U.S. But my concern is that if we don't get these rallies, we don't get the Santa Claus rally, we don't see this Q4 rally, whether it's in Bitcoin or the stock market, and we don't get a January indicator trifecta, that will be something that might begin to derail my bullish outlook. Presidential cycle, I just updated this for us today. It's just, beauteous. The dotted lines are the historical pattern from 49 to 22. It only goes to 71 for NASDAQ in the blue. And then the solid lines are the current cycle, 21, 20, the, very quintessential midterm year bottom. The sweet spot of the 4-year cycle, Q4 the midterm year through Q2 of the pre-election year, just it happened. I mean, the averages are like 19% for the Dow, or almost 20% for the Dow, a little over 20 for the S&P, and 29.3% for NASDAQ. We were ahead of all those. Off the top of my head, I don't know the numbers, but we were just above those. And then we had this Q2, Q3 weakness again, and bang, the seasonal rally right on cue. This is part of the reason I'm bullish for next year. I think we rally towards new highs, by the end of the best 6 months, a little more sideways in middle of next year, worst 6 months, Q2, Q3, and then finish the year. And, there's a whole bunch of presidential election year perspectives. There's concerns about the people, political ideological concerns about those that are running. There might be a third candidate that has some impact, but we'll find out in the beginning of the year if the power of a sitting president running for re-election will have its impact. The first 5 months are usually positive for an election year. If not, they'll start to give us a little handicapping that maybe the incumbent is not going to win, and that would dictate that the market would be a little bit weaker next year. And then there's also this little effect that I have at the end of the year. I call it the ding dong, the witch is dead effect. When unpopular presidents are ousted, the market tends to rally. That's not to say that this guy is so unpopular. We'll see what happens next year with the campaigning and other things. The mud's already slinging, but the power of a sitting president, when you have an incumbent that you have a known, market hates uncertainty. And when you have somebody who's in there, you have a pretty good idea of what the civic, economic, diplomatic, international, and market agenda will be. It's going to be the same. If it changes, then it's uncertain. So in the green line, when a sitting president is running for re-election, you have the S&P up 12.3%. And in a year when there's no sitting president running, an open field, as we say, S&P is down 1.5%. Got all years in the aggregate cycle in there for election years as well. So that's one of the things we're looking at for a bullish outlook for the stock market for 2024. So I just sort of wanted to go through some stuff we've been through. Yeah, this time is not different. All right. I mean, yeah, everything's different a little bit, but people are still behaving the same way with their money. We had the August, September weakness. We had October phobia. We expected this. We were positioned for it. Fear and sentiment, fear and negative sentiment were up. We're still tracking the seasonals and the 4-year cycles. We got our buy signal. And here's your favorite word, or my favorite new word. The best 6 months, seasonal pump cranked up right on cue in November.
Oh man, I love this. I love this so much.
All right. So, my outlook and seasonality concerns, everyone's talking about seasonality these days. I get a little concerned when too many people are talking about it, but for now it's working. Just, it works a lot, but when everyone's talking about it every day on, the internet and social and cable news and fin news and all that stuff, just be leery. So, what could derail my bullish outlook? As I said, if stocks don't rally during this bullish season and the market doesn't hit my January indicator trifecta, but we've got some tame CPI numbers. I think we avoided the U.S. government shutdown for now, but there is plenty of geopolitical turmoil right now over by you guys and then in the Middle East. But you know what? There's always political turmoil. I can't remember a year when we haven't had something going on. Seems a little bit more heated or heightened right now, but the market seems to be stomaching it pretty well. And just remember, the Fed's paused. I think they're done. They put a lot of ammunition back, in their arsenal. And if anything goes wrong, they'll cut. They will. And I don't know of a lot of recessions or bear markets, too many occurring in election years without something major like, the great financial crisis or an undecided election or, that kind of thing. So my outlook, Q4 rally for pre-election year rages on, approaching on new highs by the end of the best months. 4-year cycle continues to track. We're bullish election year, boosted by the power of sitting president. I'm looking for Dow gains in the 8 to 12% range in 24, likely more from S&P and NASDAQ, more for Bitcoin. And weakness, as I said, spring, summer, Q2, Q3 of 24. And then maybe by the end of the year, we'll be looking at my near my forecasted super boom level of 38,820 on the Dow. So go ahead, man. I was just going to run through, there's a couple of little plugs for what we do, but go ahead. You got a question.
Yeah, I mean, so there are actually some questions, in the chat as well. Still, what I would say, because we've already, got so much of the excellent insights and the predictions a little bit, the market outlook, and I perfectly agree, that there's never been a silent year in terms of, there's always this geopolitical turmoil and it's always uncertain. Still, some years, kind of like take it worse than the other ones. Having about 5 or 6, 7 minutes left, what would you say that are the leading points, the main leading narrative of 2024, right? If you were to compress, let's say, all the findings, what is going to be the one that prevails? What is going to be the main dominant tendency on the seasonals or the notes that you have?
What do you just tell me what you're thinking here? You want to know what my
Yeah, so see, I tell you what
I think the most important things for 2024 are.
So you've brought a lot of the good points, right? And it makes sense. I promised to myself, before we started the show that, it's very hard because when you're running a stream with a friend, trying to tame the smile and trying to be professional, is super hard. So when I talk to the people, Jeff, they ask me simple questions, right? They ask me the questions as simple. Znowu ucięło? They ask me the questions like, what's 2024 gonna be like? And they expect one light answer. What's that gonna be from your side?
I mean, it's all about the election. It's all about the power of a sitting president. That's my number one. My number one factor especially because the 4-year cycle is so on point. I think the Fed's done. If they cut, that will be more juice, more fuel. I think there's a lot of negativity out there. In my press release for the Almanac, I said no recession. Everyone, who's been talking about recession has been wrong. All of the fear mongers are still saying that. Those of us who've been on the right side, the few, continue to believe that we've worked through that. It's just so. Power of a sitting president, no recession, Fed's done.
That's interesting, right? And like I said, when I go to all those conferences, like they ask for by they I mean everybody who I talk to, right? They can be the bank managers, they can be the hedge fund managers, they can be the people who sit on a lot of money, they can be some of the crypto rich folks that happen to reach overnight and they're kind of like persist over the years. There are a lot of ways. However, everybody seeks those holy grails, those simple terms, those simple examples. Like, tell me what's 2024, 2025 is going to be like and they expect one simple answer, and it's so hard to ever give a simple answer, right? And you're bringing so many excellent points already here, taken out of the stock.
Did I give you a simple one?
Yeah. So what I would say is, that I'm a little bit addicted to your content, so I'm not gonna be, I'm prejudiced. I'm prejudiced because I read Stock Traders Almanac, I read your tweets, I talk to you a lot, and I'm a little bit prejudiced, right? However, what I would say is that, on my end, the halving is the key, right? Since
I was just gonna say that. That's the other thing. I'm so interested to see what happens with the halving. What's the actual estimated time now? It's changed, right?
Hold on. So let me check it real quick. So
ever since we started our research, it started to move a little bit further out, right? It was like early April, then it was late April.
It floats. It floats, right? Because it happens every 210,000 blocks, and
right.
The actual current.
I'm going to stop sharing because I want to see what's going on in the chat and see what people are asking about. See if there's something there.
Don't worry. I can actually take over. Hold on, real quick for a minute or two. Just for a minute or two, right? So this is actually 154 days. So if we take 154 days from now, what's it going to be? It's going to be 18th of April, 24, right? 18th of April. So there is not a lot of time anyway, right? 154 days or so. Again, it floats, it fluctuates. However, what we know is that Bitcoin loves to rally after the halvings, and Bitcoin loves to rally, especially, since it's backed by a lot of institutional flow.
There it is.
Right. So that's the chart. I'll try, when I speak after you, man, again, it's such a difficult challenge for me, because anything I say, is basically easily outshined by your excellent experience. So here, it's just a bare tip of a BLX, the Bitcoin Liquidity Index. Since 2010 July, right? And we kind of touched upon this in our seasonality article that we did, that has grown such successful on the prediction side. We did the best day kind of over the year. Here's the green light to October 28th. We did it. Actually, the market rallied very nicely in that time. However, the halving itself, which is supposed to happen and again in April, it typically accelerates, the markets and is an event day, right? Because there's a lot of anticipation, and just like people anticipate, by people I mean the traders, just like traders anticipate, what's happening with the BlackRock, ETF approval for Bitcoin spot iShares ETF IBTC, right? The BlackRock has just filed for Ethereum spot ETF. Again, so there is a lot of anticipation from the ETFs. There's a lot of anticipation and demand from the institutions that push the prices eventually higher, because if there is demand from the institutions, from the money managers, from the hedge funds, right, from the funds for this particular asset, it translates and transpires to bigger demand, right? And then you have the demand from the natural expectations of what halving does from the fundamental viewpoint, because what halving does, it cuts the mining rewards by half, right? And eventually leaving us with more demand per piece of Bitcoin, if you will, right? Because it's so much harder to mine the same amount of Bitcoin at same cost. It's actually impossible because the mining rewards are halved. It's becoming more and more unprofitable to mine Bitcoin. It's becoming more and more unprofitable and challenging, basically, to mine Bitcoin at the same pace, right? At the same pace, which makes it scarce, which makes it more scarce. And when there's less of it and it's less accessible, less available, we want it more. All right. And so Bitcoin aligns not only with the pre-election years and the whole seasonality that you and I kind of like discussed in our seasonality paper for Bitcoin. It also nicely aligns with the presidential election year for the next year and the halving cycle itself. And just to kind of like, get closer to the wrap of the session, just one thing from my side, right? And let's take a second to admire this. So on the bottom of the screen, right, there is the chart, the initial chart that Jeff and I did, and it was in September, and we released this article again in September 26th, right? And you can see that there is literal this anticipation, to the upside, following the September's low for Bitcoin. That is the only negative and the worst month of the year, and there is, ever since the 60%, kind of like return up to date year to date, we are actually right now over 120, 130. So there is this massive growth that it just moves completely in line with the expectations, right? And there's a lot of saying, there's a lot of, again, there's a lot of seasonal patterns that can be discovered in cryptocurrencies that actually work, right? And again, we're not going to be able to say too much. I wish we could say more. However, Jeff and I are in close touch with regarding to putting more and more content for the seasonals of crypto, because there's so much of the undiscovered world to be discovered and conquered. And well, Jeff, this is such an honor to ever have you on a session, and I appreciate your time.
Might as well.
I appreciate it. If you were to give a closing remark, to give you a closing tip for everybody who's tuned in and watched it, what's that going to be?
Just, again, watch those seasonals and keep an eye on if they're working or not. That's the one additional thing I can add, is like, if we don't continue to get this rally, something else is at play. If we continue to get it, stay long, stay strong. So, always ask the question, if not, what do you do if your assumptions are wrong?
Long and strong, right? That's what we love in crypto. Long and strong. That's why we keep saying all the time, probably too often. Ladies and gentlemen, Jeff Hirsch, Almanac Trader. Make sure you follow Jeff on Twitter at Almanac Trader. Get yourselves a copy of Stock Traders Almanac 2024. Full disclosure, I love it. I read it. I haven't got my hands on the newest edition. However, the past several copies, they are rock stars. They are literally rocking. I love this. I'm addicted to what Jeff posts. So again, probably take it with a grain of salt. I'm a little bit biased. Got to admit that. It's such an honor. Again, Jeff Hirsch, Almanac Trader, privately my good friend. And guys, you should see Jeff's timeline on how much this guy hikes. There's a lot of hiking in the beautiful nature. He's so fit. He's got so many excellent passions, and hobbies. And
it's another journey.
This guy hike, another journey.
We'll
Everybody, this is.
These days.
I'd love to join you there, Jeff, and that's going to be my honor. Ladies and gentlemen, again, thank you so much for being here. This has been Adrian Zunchik, CMT, talking to you as your host, and the ever great and excellent Jeffrey Hirsch for today's session. That's a closing. Thank you so much for joining.
Thanks, Adrian. Thanks, everybody.